Welcome to the Deep Dive, the show where we take really complex information, the kind that can make your eyes cross, and just distill it.
Right down to immediate, usable knowledge.
And today, we are strapping in for, well, an essential exploration of the statutory framework that governs Indian banking.
It's a heavy lift, for sure. But for anyone who really needs to be informed and informed quickly, maybe you're gearing up for exams like IBPS PO, SBI PO, RBI Grade B.
Or even just managing a career in finance.
Exactly. Understanding this legal architecture is, well, it's completely non-negotiable.
We know you don't want an audio textbook. You want the critical insights, the aha moments, and the context that helps it all stick.
So our mission for this deep dive is to conquer the two main pillars of Indian banking law.
That's the Foundational RBI Act of 1934 and the Operational Banking Regulation Act of 1949.
And then, and this is crucial, we have to spend some real time on the incredibly important changes that just dropped with the Banking Laws Amendment Act 2025.
These amendments, they became effective August 1st, 2025, right?
That's right. And they are, current affairs dynamite. They reflect a necessary modernization, and knowing them inside and out is key to understanding where we are today.
Okay, so let's unpack this. We have to start where the entire system starts. The central bank, the apex regulator,
The Reserve Bank of India.
which is governed by the Reserve Bank of India Act, passed way back in 1934. In simple terms, what core functions did that act immediately give to the RBI?
Well, the 1934 Act is literally the birth certificate of the RBI. Section 3 established the institution with a dual mandate. First, regulate the issue of currency.
Okay.
And second, maintain reserves to ensure monetary stability. It really set the stage for the RBI to be the guardian of the economy.
And the most recognizable job for any central bank is, controlling the money itself.
Yeah.
How does the 1934 Act grant that iconic power?
That's found under Section 22. This gives the RBI the exclusive right, a total monopoly, to issue currency notes throughout India.
That centralized power seems essential for trust in the economy, right?
Oh, absolutely. For uniformity and trust.
I remember there's a famous exception to that monopoly, though. It's a classic trivia question.
It is, and it still trips people up. While the RBI issues all the high-value notes, the smaller denominations,
The 1 rupee note.
specifically the 1 rupee notes and all the metallic coins, they are the exclusive domain of the Ministry of Finance. It's a subtle but key administrative distinction.
Okay, so beyond printing money, what kind of business is the RBI even allowed to conduct?
Section 17 details what business the RBI may transact. This includes accepting deposits from governments and commercial banks. But what's fascinating is why they accept these deposits without paying interest.
Right, why is that critical? If they don't pay interest, wouldn't that make banks want to keep their money elsewhere?
Precisely. The RBI isn't trying to compete with commercial banks.
Ah, I see.
Its objective is monetary policy, stability, not generating profit from deposits. By accepting them without interest, the RBI keeps its balance sheet pure, Its operations are focused solely on its regulatory and stabilization roles.
That makes perfect sense. And speaking of stabilization, you mentioned the ultimate safety net.
We're talking about the lender of last resort function, detailed under Section 18. This is a vital emergency power.
So what does that look like in practice?
Imagine a commercial bank is facing a sudden crisis, maybe a global shock or a massive bank run, and liquidity just dries up. The RBI can step in immediately.
And do what?
Provide emergency, short-term lending to prevent that single bank failure from causing a catastrophic chain reaction across the entire financial system. It's the law that stops panic from becoming collapse.
So that concludes the foundation. The 1934 Act built the regulator, defined its powers, and established it as the economy's lifeguard.
Correct. So now we shift from the rulemaker to the players being regulated.
Right. A central bank needs banks to regulate. So how does the second pillar, the Banking Regulation Act of 1949, step in to manage, the daily operations of all these other banks?
The BR Act is the operational framework for everyone else. And it begins, logically, by defining what banking actually is. Section 5B defines it as accepting deposits from the public for the purpose of lending or investment.
That sounds incredibly straightforward, but I imagine that specific definition is the trigger for all subsequent regulation, isn't it?
It is the legal line in the sand. And if you want to cross that line, if you want to take public deposits to lend or invest, you need permission.
And that's where the RBI comes in.
That's where Section 22 comes in. It acts as the ultimate gatekeeper. It mandates that no company can do banking business in India without getting a specific license from the RBI.
Okay, so once a bank is licensed, how does the BR Act make sure it's strong enough to handle public trust?
That's the job of Section 11. It prescribes the minimum levels of paid-up capital and reserves every bank has to maintain.
This isn't just bookkeeping, I assume.
No, not at all. This capital acts as a buffer. If a bank takes some unexpected losses, that capital absorbs the blow before the public's deposits are ever at risk.
And the oversight doesn't just stop once the license is issued. The RBI has to be able to peek behind the curtain.
Precisely. Section 35 grants the RBI comprehensive power to inspect any banking company anytime. This isn't just reviewing papers, it's active, continuous supervision.
So they can look at asset quality, management, risk.
All of it to ensure systemic health in real time.
Before we move on, there's a crucial social responsibility clause in the BR Act about dormant deposits. What happens to that money?
That's Section 26A. It established the Depositor Education and Awareness Fund, or DEF.
DEF.
This fund manages deposits that have gone unclaimed for 10 years or more. Instead of just sitting on a bank's books, this money is transferred to DEF and used to promote depositor education all across the country.
So it shifts the funds from being a liability to a public good.
Exactly. It's a great example of law reflecting broader policy goals.
Okay, now let's tackle the two acronyms every finance professional has to master: CRR and SLR. We need to clearly explain not just what they stand for, but how they differ.
This distinction is absolutely vital, and the fact they're governed by different acts is the first key insight. Both are calculated based on a bank's NDTL.
Let's pause there, because NDTL is the foundation. What exactly is net demand and time liabilities?
Think of it as the bank's total commitment to the public. Demand liabilities are things you can withdraw immediately, like a savings account.
Right.
Time liabilities are fixed deposits. The net part just accounts for liabilities minus certain assets. So basically, NDTL at how much money the bank owes its customers.
Got it. So now that we know the base, let's start with CRR, the cash reserve ratio.
CRR is rooted in the RBI Act, specifically Section 42(1). The mechanism is simple. A certain percentage of the bank's NDTL must be kept as cash with the RBI itself.
And here's the kicker.
Here's the kicker.
Yeah.
Banks earn no interest on this reserve.
So the RBI is forcing banks to lock up a part of their lending capacity and not paying them for it. What's the policy goal there?
It's a powerful tool for monetary control. By raising the CRR, the RBI effectively sterilizes liquidity from the system.
It reduces the amount of money banks can lend out.
Exactly, which helps cool down an overheated economy and fight inflation. It's an external controlling lever.
That sets up a perfect contrast with SLR, the statutory liquidity ratio.
Yeah.
How is this purpose different?
SLR is governed by the BR Act under Section 24, and its purpose is internal liquidity and stability. It's not really about broad monetary control.
It's about making sure the bank itself is safe.
It's about ensuring the bank has immediate resources to meet unexpected demand from its own depositors.
So unlike CRR, these assets are held by the banks themselves.
Exactly. They maintain a percentage of their NDTL in highly liquid assets on their own balance sheet, things like gold, cash, or most commonly, government securities.
And because they hold these assets,
They do earn interest on the SLR amount.
that contrast is essential. CRR is the regulatory tool for inflation, held at the RBI, no interest. SLR is the bank's internal safety net, held by the bank, and it generates interest.
Perfect. With that foundation, we have to move to the most critical current affairs element, the Banking Laws Amendment Act, 2025.
This is where we need to spend some time. We identified 5 major changes. Let's start with the one that affects every single account holder, nominations.
The old system was so outdated. Only one nominee was permitted per account. The 2025 amendment completely modernizes this.
How so?
Now, account holders can appoint up to 4 nominees, and they can be simultaneous or successive. It's a massive win for retail depositors and, estate planning.
That is a practical, user-friendly change. Okay, now let's talk about the one with a spectacular jump in value. The substantial interest threshold.
This is maybe the most attention-grabbing one. The old legal threshold for substantial interest in a bank was set decades ago at just 5 lakhs.
Okay, and the new one?
The 2025 Act revised this drastically to 2 crore rupees.
2 crores. That's a 40-fold increase. What is the policy implication of such a colossal jump?
It's a strategic regulatory move. 5 lakhs is nothing in today's economy. By raising the threshold so dramatically, the RBI shifts its limited oversight resources away from medium-sized investors.
And focuses on the truly major stakeholders.
Exactly, the ones who can actually exert significant influence. It streamlines compliance and focuses attention where systemic risk truly lies.
It's a perfect example of modernizing regulation. What about internal continuity for cooperative banks?
That's the director tenure amendment. Previously, tenure was capped at 8 years. The amendment extended this to 10 years.
And the reasoning is just stability.
Stability and continuity. Running a complex financial institution needs long-term planning, and the extra 2 years allow for better execution of strategic goals.
And there's a huge reform for public sector banks, specifically about their auditors,
Yes, the audit reform is transformative for governance. Historically, remuneration for auditors and PSBs was fixed rigidly by the government.
which made it unattractive for top talent, I imagine.
Very unattractive. The 2025 Act now grants PSBs the autonomy to fix their own auditors' remuneration.
So what does that freedom unlock for them?
It lets them compete in the market for talent. By offering competitive pay, they can attract the absolute best auditors, which dramatically improves financial oversight, risk management, the whole system.
High-quality audit equals higher stability. Okay, finally, let's wrap the amendments with unclaimed shares.
Before, unclaimed shares in banking companies often just languished on the bank's books. The new provision mandates that these assets must now be transferred to the IEPF.
The Investor Education and Protection Fund.
Exactly. So assets from inactive investors are managed under a centralized, government-regulated umbrella, not internally by the bank.
Okay, so a quick summary. Retail flexibility is up with 4 nominees. Regulatory focus is narrowed with the 2-core threshold. Governance is stabilized with the 10-year tenure.
Quality of oversight is improved with audit autonomy.
And investor protection is centralized with the IEPF. 5 essential updates.
Critical touchpoints that connect the abstract law to financial practice in India today.
While those 2 acts are the pillars, reality is defined by several other pieces of legislation. Let's briefly touch on the supporting landscape.
The first one provides comfort to every saver. The DICGC Act of 1961.
The Deposit Insurance and Credit Guarantee Corporation Act.
It guarantees that if a bank fails, a depositor is protected up to a certain limit.
And what is that current safety limit?
Currently, it's up to 5 lakh rupees per depositor per bank.
That per bank part is crucial.
Very crucial. Spreading your funds can maximize that protection.
Okay, now, the bank's nightmare scenario. Bad loans, or NPAs. How do they recover those assets quickly?
That's the work of the powerful Sarfisi Act of 2002. This is the bank's fast pass. It lets them seize and sell secured assets like property to recover bad loans without going through the courts.
That speed must be the game changer.
It is. It prevents asset values from eroding during long legal battles. Then there's FEMA 1999, which governs India's financial interaction with the world.
Like the Foreign Exchange Management Act.
It replaced the old restrictive FARA and governs all international trade and foreign exchange.
And finally, a very old act that still governs day-to-day transactions.
The Venerable Negotiable Instruments Act of 1881. It covers checks, promissory notes, bills of exchange.
And there's one key section everyone needs to know.
You must know Section 138. It deals explicitly with the offense of a bounce check, outlining the penalties and legal recourse.
We've established the full legal framework. Now let's connect these laws to the most active economic levers. The monetary policy tools the RBI is using right now.
The ability to manage these tools is granted by the very acts we've discussed. The interest rates are the direct mechanism for impacting commercial bank behavior.
Let's define the purpose of the big 3. Repo rate, reverse repo, and the bank rate.
The repo rate is arguably the most dynamic tool set by the Monetary Policy Committee. This is the rate at which the RBI lends money to commercial banks, usually for short periods.
So if the MPC raises the repo rate,
Commercial banks' borrowing costs go up, they raise their lending rates, and that slows down credit growth and tames inflation. It's the primary inflation control tool.
and the reverse repo.
That's the mirror image. The reverse repo is the rate at which the RBI absorbs excess liquidity from the banks. Banks park their extra cash with the RBI for a risk-free return.
And the more traditional long-term rate.
That is the bank rate, defined under RBI Act Section 49. This is the rate for long-term lending. While the repo rate is for day-to-day management, the bank rate sets the long-term floor for credit.
To bring this full circle, let's quickly reiterate those twin levers, CRR and SLR.
Remember, CRR under the RBI Act is held with the RBI with no interest. It's the tool for high-level monetary control. SLR under the BR Act is held by the bank itself, earning interest, and it's the tool for immediate internal liquidity.
They represent the two halves of the regulatory commitment to a stable banking system.
Exactly.
We have successfully mapped the jurisdiction of the two foundational pillars, covered essential acts like SARFESI and DICGC, and critically, we've dissected those 5 game-changing adjustments from the 2025 amendments.
Especially that massive shift in the substantial interest threshold to 2 crores.
Right.
The overarching theme of these 2025 amendments is striking a balance between regulatory efficiency, like the audit reform, and retail empowerment.
And that raises an important question for you, the learner, to carry forward.
If the big systemic tools like the repo rate are focused on macro issues like inflation, how significant is the micro-level protection, specifically being able to name 4 nominees instead of one in shaping overall household trust and future savings habits?
Especially when you view that against the bank's own operational health goals.
It's a tension between high-level policy and deeply personal consumer rights.
And that is something worth mulling over as you solidify this knowledge. Thank you for joining us for this deep dive into the statutory landscape of Indian banking. Use this streamlined information to be well-informed and confident. We'll talk to you next time.